Welcome back to the Deep Dive. Today we're digging into Omnicom's Q2 2025 results, the earnings report, the investor presentation. We'll look at the numbers, the big moves, and what it signals for the marketing world.
Yeah, it's quite a revealing set of documents. You see a company clearly making some big bets, balancing immediate impacts against longer-term strategy.
Yeah.
We'll get into the headlines, but really the story is under the headlines.
Okay, let's jump right in. Top line revenue for Q2 2025, $4.0 billion. That's up, what, 4.2% year over year? Pretty solid.
It is, yeah, $4.0 billion versus $3.85 billion last year, and organic growth was 3.0%. But, where it gets really interesting is the profitability picture.
Right, because the reported numbers look, well, not great compared to the adjusted ones.
Exactly. That's the key tension here. The reported cap net income, that standard accounting figure, it was $257.6 million. Now, that's quite a drop from $328.1 million the year before.
Oh, yeah.
And the earnings per share followed suit, $1.31 reported, down from $1.65. So on the surface, you'd ask, revenue's up, why is profit down?
But then you flip to the non-GAAP, the adjusted figures, and it's a completely different story.
Completely different. Adjusted net income was actually up $401.1 million compared to $386.9 million last year. And adjusted EPS, $2.05, up from $1.95.
Okay, so a significant difference. For listeners trying to make sense of this, why the huge gap? What's being adjusted out?
It boils down to two major specific cost buckets they pulled out for that adjusted view. And they're pretty upfront about them in the report, which is good. First, you've got $66 million related to the big one, the pending merger with Interpublic IPG. That's, legal fees, advisory costs, stuff directly tied to that transaction. Definitely a one-off kind of thing.
Okay, makes sense. And the second?
That was another $88.8 million they call repositioning costs. Reading between the lines, this looks like severance and restructuring, mainly in their advertising and production groups. So basically costs tied to making the company more efficient moving forward.
So add those together. What's that, about $155 million?
Yeah, $154.8 million to be precise. And that is what really hit the reported operating income. It dragged the margin down from 13.2% last year to 10.9% this quarter.
So you're really seeing the immediate price tag of these big strategic moves. It's not necessarily that the core business is sputtering. It's that they're spending significantly on future positioning.
Exactly. It's investment disguised as cost on the P&L right now. And the CEO, John Wren, he kind of highlighted that, pointing to the 3.0% organic growth despite all the macro uncertainty out there. He called it resilient.
Okay, so that explains the profit piece. Let's pivot then. Where is the growth coming from? That 3.0% overall organic growth must have some stronger areas propping it up.
Oh, absolutely. And it's quite concentrated, actually. Media and advertising was the real star, up an impressive 8.2% organically. Precision marketing also strong, up 5.0%.
And those are big chunks of the business, right?
Huge. Together, they're about 68% of Omnicom's total revenue. And if you look at just those two combined, their organic growth was over 7%. That tells you a lot about where client money is flowing towards data-driven, targeted campaigns.
Makes sense.
We also saw some decent growth in experiential, up almost 3%, and execution and support up about 1.5%.
But not everything was growing. There were some notable declines, too. Public relations down quite a bit, healthcare, branding.
Yeah, that's true. PR was down 9.3%. Healthcare saw a 4.9% dip. And branding and retail commerce took a pretty big hit, down almost 17%.
So what's your take there? Is that an Omnicom-specific issue, or are those areas facing broader headwinds?
It's probably a bit of both.
Yes.
Some of it might be clients pulling back in uncertain times, maybe shifting budgets towards things with more immediate, measurable ROI, the digital advertising and precision marketing we just talked about.
Yeah.
Branding can sometimes be seen as more postponable.
Okay. And geographically? Any standouts?
Definitely. Latin America just jumped off the page, 18% organic growth. Really strong performance there. Asia Pacific was also solid at 6.5%. The U.S. came in right at the company average, 3.0%.
And the UK was the only negative region.
That's right. UK was down 2.5%. Most other regions showed positive growth, but LATAM and APAC were clearly the highlights, showing where the global opportunities might be strongest right now.
Let's talk more about strategy then. That Interpublic merger you mentioned, that's obviously huge news for the industry. What's the latest status?
Well, the big hurdle cleared recently was getting U.S. antitrust approval. That came through in late June, which is critical.
Okay, good news for them.
Yeah, a major step. They still need sign-offs from 5 other markets, but they're sticking to their timeline, expecting it to close sometime in the second half of 2025. It's clearly the centerpiece of their future scale and growth plans.
And internally, they keep highlighting their Omni platform. Plus, they got that Effie Award for effectiveness. How important are those pieces?
Very important, I'd say. The Omni platform is their sort of integrated operating system, essential for delivering those data-driven solutions clients want, and frankly, for driving internal efficiency, too. And the Effie Award, that's external validation that their work, well, works. It helps win business.
Right.
But, they also flag the usual risks: global economy, geopolitics, inflation, interest rates, the standard list for any big multinational. They also specifically mentioned cybersecurity and managing AI, which is becoming increasingly important.
Yeah, AI risk is definitely one everyone's watching. Okay, so strategy seems clear, growth areas identified. How's the underlying financial health? Can they support all this?
Looks pretty solid, actually. Their capital management seems strong. They bought back $142 million in shares this quarter, on track for about $600 million for the year, which is kind of their historical norm. So confidence there.
In cash flow.
They highlighted a $250 million improvement in operating capital year to date. So, yeah, managing cash well, which is crucial when you're doing big deals and restructure.
What about the returns they're generating? ROE, ROIC.
Return on equity was 34.0% over the last 12 months, and return on invested capital was 18.2%. Now, both are down slightly from the prior year, likely due to those costs we talked about, but those are still very healthy return metrics.
That does sound strong. And debt.
Their key leverage ratio, net debt to EBITDA, is actually down. It's at 1.2 times now, compared to 1.5 times last year. So they're managing their debt well, which gives them flexibility. It suggests, a solid financial footing as they navigate these big changes.
So wrapping this up, the Q2 picture for Omnicom is really, it's about transformation, isn't it?
I think so. It's a clear narrative of a company making deliberate, significant investments, the IPG deal, internal efficiencies that are shaping its future, even if it means taking a hit on the reported numbers right now. And it really leaves you thinking about that core challenge for companies in this space. How do you juggle the need for solid quarterly results with making these bold, sometimes expensive strategic moves that you absolutely need to make to stay relevant and grow long term? It's a tough balancing act.
It really is. Well, that gives you a deep dive into Omnicom's Q2. Hopefully that provides a clearer view of their performance and where they're headed. Thanks for joining us.
My pleasure.
Until next time, keep digging for those insights.